Today, I'm going to talk about practice question 6.1, empirical evidence on CIP. Before talking about practice questions, I'm going to quickly review on CIP and topic 6.1. In topic 2.1, we derived CIP first with these assumptions. Default-free deposit, no counterparty default risk for forward contract, and no transaction cost. Then we derive the CIP formula for any currency DNF. So 1 plus IFT, this is the 1 plus F currency interest rates you're going to get after 1 year of investment in F money market. So this is the one you're going to get after 1 year investment. Or alternatively, you can convert F into D and put that D into D money market instrument. After 1 period, you're going to convert D back into F using forward contract available today. So what you see here is the after 1 year, you're going to get either this return or this returns. Now, given these assumptions, what is important about these assumptions? First of all, you know for sure you're going to get this one after 1 year. This is default-free bond. And this one is also default-free bond. And because of no counterparty default risk, for the contract you buy today or sell today, that will be actually the exchange of money will happen after 1 period at the maturity. So there is no risk here, no risk here. So this is kind of low one price. If you invest into risk-free asset, either this way, left-hand side, or either right-hand side, you're going to get the same return, low one price. Now, given this CIP relationship, we can derive this relationship. So the meaning is high interest rate currency should have forward discount. So you need to know 2 forms of CIP. Now, why these assumptions are important? I told you already, so can be risk-free, this can be risk-free. But in fact, we can relax this assumption a little bit. This can be actually defaultable deposit. But still, we can get this equality. In which case, let's assume the default risk for bond for F and bond for D are equal. So if the default risk for F and D are equal, we can say that still we have same risk in the left-hand side and right-hand side. So still low on price. We have same return for the similar risk. So we have 2 different ways of investing into money market, one in domestic, one in foreign. Even though they are defaultable bond, if the risks are exactly same, we should get the same return. Again, low on price. So we can relax this one a little bit. Anyways, once we get inequality like this, so from this one, if we have inequality like this, then I explain in topic 2.1, we have to always express something like this. Always 1 plus interest rate is lower than something else. Then we're going to think about arbitrage strategy of borrowing currency D and converting investing into foreign money market. So after 1 period, this one minus this one is going to be your riskless profit. That's what we learned in topic 2.1. By the way, if you have any question, you can ask me questions using chatting window, or you can just directly speak to me. Anyway, in the last week's lectures, we talk about 2 different ways of defining CIP deviations, so-called CIP deviations. Before 2007 to 2009 financial crisis, we defined the CIP deviation in this form using the form we have here. So if CIP holds, this should be equal to 0. We talk about 3 papers, Frankel and Levick, 1975, 1977 papers, and these guys, 2008 papers. First of all, Frankel and Levick, they found many non-zero CID, so CIP violations, when they compute this one using 3 months T-bill and euro currency rate. They use specifically UK, USA case, the case 1, case 2, Canada, USA case. First of all, for T-bill case, they find that once we take into account bid and ask spread for spot exchange rate, forward exchange rate, and T-bill, 80% of profit opportunity will be gone. What about the 20%? They said for T-bill, in order to buy T-bill, actually, you have to invest into each country's monetary bond market directly. So you have to convert your own money into foreign currency, and you have to buy the foreign currency T-bill in that country. When you do that, actually, you have to worry about political risk of foreign country, also domestic countries, and you also need to worry about sovereign credit or default risk with this T-bill. Even though this is issued by government, sometimes you have to worry about default risk. So you may ask, UK, USA, Canada, USA, you don't expect to see big political risk or sovereign credit default risk, but still, compared with the USA, you may say that UK has a little bit higher probability of going to bankruptcy. Even Canada could have higher probability of going to bankruptcy. Here, bankruptcy doesn't have to be bankruptcy, it just means the UK government cannot pay the full government debt for some reasons. So we can say that as a credit risk. Doesn't have to be bankruptcy. It just means they don't pay a certain amount of their debt for some reason. Anyway, so in order to avoid this kind of issues, so we have to worry about political risk or sovereign credit default risk, they investigate CID using euro currency rates. So what are the euro currency rates? For example, LIBOR. LIBOR is a London interbank offer rate. So it's issued in the same city, London, and this is the borrowing or lending rate between similar group of banks with similar credit risk. So you are borrowing and lending in one place, so you don't have to worry about political risk. And you're gonna borrow and lend from a banks of similar credit risk. So as I told you already, in CIP case, even though we derive CIP with default-free deposit assumption, in fact, we can allow default risk. If default risk for F and D are similar, then we can still get the CIP expressions because this is the law of one price with a similar risk. So for that reason, we don't have to worry about political risk. We don't have to worry about credit risk when we test CIP or when we compute CID using euro currency rate or LIBOR. In that case, Frankel and Levick find 100% of profit opportunity will disappear. So CIP hold. That's what they find. CIP hold during this period. Now, these three guys says, well, that is true, but if we use intradaily data, transaction data for euro, dollar, pound, dollar, yen, and compute this CID every second every seconds, you could find violations of CIP for a certain short period, like 1 second period. So that what they find is there could be some violations, but once there is a violations, that will be quickly exploited by some high frequency traders. So the CIP violation will not be there for a long time. Yeah, so basically this paper, Franklin Levick, used LIBOR in their example. Now, currently, as you said, LIBOR is not available, but we have some alternatives for each LIBOR nowadays. And then you have to think about whether using borrowing and lending using that alternative could induce political risk or default or credit risk. If there's no political risk or default credit risk, then you don't have to worry about this issue. But if you think there are political risk or default credit risk, then you could find some of the CIP violations. So Franken and Levick just use the LIBOR and find in that ideal case, CIP hold. But obviously, CIP might not hold with some less ideal case. Then you have to worry about these two. Is that answering your questions? So what I'm trying to say is that when you try to think about low bond price, it should be really low bond price. You have to, for CIP case, both should be risk-free investment, or both should be investment with the same risk. If there's a reason to believe, so you have different risk for this thing and this thing, then maybe equality is not going to hold. You should learn this logical thinking. So the important thing is not about whether CIP hold or not. It's more about the applying the same logic for any low one price case or any possible arbitrage case. Anyway, but during 2007-2009 financial crisis and afterward, we observe also CIP violations, CID. Well, all other research since 2007 financial crisis, they use this form of CID. So this is based on we talk about two different forms of CIP, right? This form and this form. And after 2007, they defined CID using this CIP form. So I told you already, if we have this inequality, what's the meaning? You have to borrow currency D and convert, invest into currency F money market. After one period, you're going to convert that back into D using forward contract. So difference is going to be your arbitrage profit, right? This is what I explained already in previous slide. Now, Papa and Pekka said they find many non-zero CIDs during the financial crisis, CIP violations, or even Euro USD case, GBP USD case, Swiss franc USD case for G10 currency developed market. And since they use the Euro currency rate like a LIBOR, you don't have to worry about default risk as before. You don't have to worry about political risk issued in one city, issued by a group of similar banks. And they, the other guys said, if taking into account bid and ask spread, you still find CIP violations. So the usual suspect identified Franklin and Levick. They cannot explain CIP violation during financial crisis. So Baba and Pecker point out we have to also focus on this one, the counterparty risk in the forward contract. So when I derive this CIP relationship, we need default free bond, no counterparty default risk on forward, right? Because of these assumptions, both investment can be risk-free. Now, this IF and ID are not going to be the reason for CIP violations. Then we have to take a look at this one here. Now, forward contract is the negotiated contract from between two parties, right? So you have to know that first. And you need to know that this interest rate and exchange rate, spot exchange rate are determined in market. And forward price is the negotiated price between two parties. So that's the important difference. So this forward price is going to be determined by two counterparties involved with that contract. So maybe if you are one of the counterparties, you can influence the price, right? You can change the price. Anyway, so we use this example. Let's suppose UK banks want to borrow dollar. During the normal times, UK bank just can borrow dollar directly from US banks. And we can interpret the left-hand side of CIP form, as 1 plus interest rate UK banks need to pay after one period, the dollar interest rate, 1 plus dollar interest rate, right? And based on that appendix, you should read the appendix, and you should watch the video clip on appendix. UK banks can borrow pound and give this pound to the swap dealer in today's market, spot market, and make a promise to do the reverse thing in the future using forward contract. That's so-called borrowing dollar indirectly using FX swap. So UK banks have two ways of borrowing dollar directly from US banks, or borrowing pound and using FX swap to eventually borrow dollar. Then we can interpret this as the interest rate, dollar interest rate, 1 plus dollar interest rate for the borrowing dollar indirectly using FX swap. Okay. Now, during normal time, we have equality. We don't have to worry about counterparty default risk. However, during the crisis period, so let's say UK banks borrow dollar indirectly by FX swap today from some US financial institutions, borrow dollar indirectly using FX swap. Then after one period, so UK banks will make a promise today to give dollar to US banks and get pound. So this is for the contract. Spot contract, they're gonna give pound to US and get dollar today. The spot market, UK banks borrow pound, give pound to US institutions. UK banks get dollar today. So this is spot. In the forward, they're gonna reverse it. Reverse it means they're gonna pay back dollar to US institutions, and they're gonna get pound at the maturity. Let's say UK banks may not be able to implement this forward price at the maturity. So UK banks may not be able to pay back dollar to US banks for a certain reason. During crisis time, there was a global dollar shortage issues. So maybe this is the realistic case. Then US banks end up with having unwanted extra pound because the US banks get pound at the spot and they couldn't get the dollar back at the maturity. So at T+1, they have US institutions have more pound and less dollar. Thus, UK banks on the dollar borrowing side of FX swap were perceived as risky because of this issue. US banks don't want to get extra pound. So I talk about two different reasons. For example, pound, during the crisis time, usually pound depreciate and dollar appreciate. So you don't want to hold an asset with declining value, right? So you don't want to hold pound during the crisis, US banks. Number two, during the crisis time, you have to worry about bank run in the even US. So US banks do not want to lend the dollar that much during the crisis time. They want to keep some of the cash inside the bank because they worry about bank run. So because of those two reasons, US banks, when they initiate swap contract with UK banks at time T, they are worried about this counterparty default risk. They might not get dollar back at the maturity. So what they're going to do is this change forward price to increase this value. Again, the forward price is the negotiated price between, in this case, UK banks and US institutions. And this is the interpretation of the right-hand side is the 1 plus dollar interest rate. Now, the dollar interest rate is the lending rate of the US banks to UK institutions. This is what US institutions will get at the maturity, 1 plus dollar interest rate. They have an incentive to get the higher interest rate for their risky activity. US banks are going to lend some money to UK banks at time T, and they are worried about this risk of counterparty default risk. So they're going to charge higher interest rate by decreasing this one. Actually, by decreasing this one means they're going to get the bigger dollar at T+1. By decreasing this one, they're going to get the bigger dollar at T+1. Why? Well, I don't know. Do you need to know that or not? Decreasing this one means US banks will give pound back to UK banks, and they're gonna get dollar. So this means for every £1 US banks give to UK, they're gonna get the higher dollar. So when in the forward market, at the maturity, US banks will give pound back to UK banks, and UK banks will pay back dollar to US banks. So decreasing value here means for every pound, you have to pay more dollar. That's the meaning of declining for the price of pound per dollar. For every £1 US banks give back to UK banks, they're gonna get bigger dollar amount. Anyway, so US banks will get bigger dollar amount at maturity. So it's like charging higher interest rate or lending dollar through FX swap. So we can rationalize why we have this inequality during financial crisis. Why you have to pay higher interest rate when you borrow dollar indirectly using FX swap. So basically, you are not able to borrow directly. So if you want to borrow dollar, you have to pay more, the bigger interest rate by using FX swap. That's what happened during the financial crisis. So as a result, even though we have this inequality, basically UK institution, they cannot implement arbitrage strategy based on this one because they cannot borrow dollar directly. UK banks or UK institutions, they cannot exploit this one because there is no way to borrow dollar directly for this guy. Now, there are some lucky US financial institutions. They are able to borrow dollar from dollar depositor in US, and they are able to lend dollar to foreign institutions like UK banks and charge a higher interest rate, right? So US banks, they couldn't get 1 plus I dollar from US dollar depositors. They will be able to use FX swap to lend that dollar amount to foreign countries, financial institutions like UK banks. They're gonna get higher interest rate. So difference is gonna be their profit. For some US banks, they couldn't make profit because of this inequality. But is this an arbitrage strategy? But this is not arbitrage strategy. US banks is getting bigger interest rate profit because they are taking counterparty risk. They are taking this risk, so they're gonna get the higher interest rate, and this is not an arbitrage strategy. So that is what Barber and Pecker says happened during the financial crisis, why we have inequality like this. Now, in these Friday's sections, we're gonna learn why we still observe this case after financial crisis. After financial crisis, the counterparty default risk wasn't that high. So if Barber and Pecker is correct, after financial crisis, we should recover equality because the counterparty default risk is not that big anymore. Or the magnitude should be much smaller than the magnitude during financial crisis. But that didn't happen. So many papers try to understand why this is happening, why we still see big CIP deviations even after financial crisis. So with this inequality, basically what you can do is we already explained this one, borrow dollar, convert invest into pound money market using forward contract, you're gonna convert that back into dollar, and the difference is gonna be your arbitrage profit, right? Or I can rewrite investing into pound in this form. So I'm just using the Baba Pecker's idea. How do you make money here? You get dollar deposits, so you are US institution, US banks, you get dollar deposit. So this is the one you have to pay back to your depositor after one period. And this is what you're gonna get through FX swap, so your dollar lending, right? So instead of saying this one, invest into pound, I can say that lend dollar via FX swap. So you are US banks. If you have this inequality, you're gonna get borrow dollar from your depositor, and you're gonna lend that dollar to foreign institutions via FX swap. and you're gonna get the difference as your profit. And one more things, after financial crisis, counterparty default risk is not that big, right? So what's going on? This guy says basically there is additional cost for exploiting this arbitrage strategy. This is so-called limit to arbitrage case. There is a limit to arbitrage. In the textbook, we always says arbitrage is easy. You have two price for the same thing, so we buy low, sell high. That's only true in the textbook only. So in certain case, because of regulations, because of transaction cost, you may not be able to actually implement this simple arbitrage strategy. This guy says the regulation was the reason. So I'm going to explain this one more clearly in this Friday's lectures, but basically what they said is if you want to buy or sell forward contracts, so you are working for US institutions, and in order to implement this arbitrage strategy, you have to buy forward or sell forward, right? Now, it means you have to make position in forward contract. What this guy found is since 2015, if financial institution, US financial institution or any institution working in European market, any banks in European borrowing and lending market, if they want to buy or sell forward, and if that forward contract is remain in their bank balance sheet at the end of each quarter, they need to pay some cost for that. If you want to take risk positions, forward market positions, and if that remains in your balance sheet, you have to raise some money in order to avoid some risky situations. So when you raise some money, you have to pay some additional cost, the money raising cost, capital raising cost. So I will explain more clearly this one. Anyway, so because of regulations, US banks has less incentive to implement this strategy, especially at the end of each quarter. So what they find is the CIP violation seems to much bigger at the end of each quarter. So this is because of regulation, maybe some banks may not be able to exploit these arbitrage situations. So and then this guy says, before financial crisis, high leverage, any banks can do very leveraged investment. So leveraged investment means borrowing something and lending something. And we observed very high debt ratio before financial crisis, even for major banks. So major banks basically acted something like hedge fund before 2007. They had so much leveraged induced investment. However, during financial crisis, everyone was worried about the systemic risk in the banking sectors. So what they says is the banks take too much risk in their investment. And then all the regulators, all the policymakers says we shouldn't allow the commercial banks to take too much leverage or too much risk, right? Because of that, there has been many pressure from many sides, government, the SEC, many places. There has been big pressure from those guys to the banks says, don't take any leveraged investment. Don't do that too much. There was a huge pressure. So this guy says, because of that pressures, leverage in the bank becomes lower and lower after financial crisis. And obviously exploiting this one is also leverage induced activity because you have to borrow dollar and lend dollar. Because of this circumstance, the banks couldn't exploit these arbitrage situations frequently compared to the pre-crisis period, right? So because of regulations, because of a lot of pressures for taking leverage, we couldn't, and US banks couldn't exploit this inequality since financial crisis, so that we see this kind of violations. That's what this guy said. Finally, this one says money markets are segmented. What they mean is, well, we use just one interest rate here, but there are many different financial institutions, hedge fund, US banks, commercial bank, or non-commercial bank. They may have different credit risk. When they borrow dollar, they may have to pay different interest rate. So money markets are segmented means when we try to implement arbitrage strategy based on this one, you should know what is your interest rate specific to you. We cannot use any interest rate to compute this one. You have to use the borrowing rate for you specifically here. You have to use the lending rate you're gonna get specifically here. And after careful research, they find that indeed, still they find that there are some arbitrage opportunities still available for high-rated banks, some banks with high credit rating. So what they find is first, this inequality only true for a high-rated banks. Okay, so these banks could exploit this inequality. However, what they find is even for these high-rated banks, they find the limit to the scalability of arbitrage trade. What is the meaning of this? The meaning is we can exploit this one with $1. That's our example, or $100, or $1,000, or $1 million. What I'm trying to say here, if you exploit this inequality using $1, your profit is going to be really low, right? If you exploit this inequality with 100, 1,000, 1 million, obviously you want to exploit this inequality using $1 million. Then what this guy said is, when you borrow $1, your interest rate is going to be really small. But if you borrow $100, you have to pay higher interest rate. If you borrow $1,000, you have to pay even higher interest rate. If you want to borrow $1 million, your interest rate is going to be really big. That's called limit to the scalability. You have to pay higher and higher interest rate. So this could be, you can exploit this inequality for, let's say, $1,000 borrowing, but you cannot exploit this inequality for $1 million borrowing. Basically, you're not gonna make that much money. You can make some risk-free money, but it's so small, so you're gonna just leave it on the street. You don't want to exploit this inequality only if you are able to borrow $1 million at that interest rate, you're gonna implement this one, right? Okay, so this is the summary of the empirical evidence on CIP. Given that summary, let's talk about practice questions involved with this empirical evidence on CIP. So first one, explain why the covered interest rate parity condition can be violated during the financial crisis based on the Baba and Becker. So basically, you have to summarize the appendix and page 13 to page 23 of topic 6.1 slide. So that's what I already explained here, right? So based on the appendix, you have to explain clearly why we can interpret left-hand side and right-hand side as two different ways of borrowing dollar. And then you can use this example to say that why we were able to see this inequality at the time and why that is not the risk-free arbitrage strategy, right? Basically, summary of that can be the answer for these questions. And explain why the CIP condition can be violated based on these three guys. So even though CIP violations exist because of regulations, because of these big pressures from all over the place, and because of this different market segmentations, because you have to use the realistic borrowing rate for $1 or $1 million case, etc. You cannot actually implement CIP conditions, so CIP violations was just there, right? So you have to just summarize those kind of things. Very easy, the summary of the slide. Now, more important thing is this one. Kim Deal, a foreign, so this kind of question could be in the actual exam. Kim Deal, a foreign exchange trader working at AMBS hedge fund in New York, US, has uncovered. So uncovered just means found, discovered. This is the one of the previous year final exam questions. Some students were very confused about this word, so maybe it's better to use discovered now. Kim Deal discovered persistent violations of CIP for US dollar and Mexican peso. Using historical data, Kim Deal implement an FX strategy exploiting this opportunity, basically implementing arbitrage strategy, and confirm spectacular dollar returns. Explain the reason why such return can be considered as a reward for taking risk. So what you need to know is this CIP is derived with these assumptions. There is no risk with the treasury bill for country F, country D, and there is no counterparty default risk. What if there's a difference in the default risk? What if there's a counterparty default risk, right? Obviously, for USD and MXN, unless something like LIBOR is available for Mexican peso, which is not available, for emerging market currency, there's no the external currency market. So you cannot borrow and lend USD MXN in one place from this group of the banks with a similar credit rating. So you cannot, you should use the treasury bill type things. Then you have to worry about different default risk. So that's the first thing you have to say. And also you could mention that during certain period, you have to worry about counterparty default risk. Because of that, you may have to ask premium for that. So why earning some money from exploiting the CIP violations can be regarded as the risk premium? Because of the default risk and because of the counterparty default risk, right? So that's the answer for this one. And also you may want to mention this one here. We talk about negative skewness of emerging market currency. That means that sometimes emerging market currency could depreciate hugely within very short-term period. Because of the risk, let's say if you convert dollar and into Mexican peso and buy the Mexican peso treasury bill, after one period, even though you have the forward contract, so because of forward contract, you are actually removing your currency risk. However, what if there's a crash? Then maybe this could increase the possibility of counterparty default risk. Because of crash, the Mexican, so you lend dollar to some Mexican institutions, they refuse to pay back the dollar at the maturity because of just this crazy things happening in the currency market, right? So I gave the perfect mark to the answer mentioning also this crash risk based on topic 1 at the time. But the answer, the mentioning default risk and counterparty default risk, I gave some above 35 points at the time out of 50. And also in your answer, you have to write down CIP form clearly. You have to write down CIP form just like this and explain clearly the assumptions and explain clearly we got this CIP only if this is the case, but for dollar and Mexican peso, you may have to worry about difference in default risk. Maybe IFT and IDT, they have different default risk. And also you have to think about counterparty default risk, right? So you have to write down your answer very clearly using equations and symbol and explain very clearly. Then for those kind of answer, I gave something like 40. Okay. So if you just mention default risk and counterparty default risk, you could get maximum 35. But if you write down everything clearly with the equations, etc., you get the more than 40. And if you mention skewness crash risk based on topic 1, and the answer got the 50. I will explain more clearly in the revision class what I expect from the answers in the short questions. But anyway, this could be hint for you how to write these answers for short questions. Anyway, so that's the answer for this question. But what if I change the question to something like this? Explain the reasons why obtaining such returns can be challenging. So this is not about risk premiums. This one actually asks you to write down all possible reasons for why it is difficult to exploit these CIP violations. Then basically you have to summarize everything. First of all, because of risk premium, so default free, the difference in default risk and counterparty default risk, and also you need to mention the transaction cost because of bid-ask spread. It may not be easy to make money based on that. Also, you have to mention perhaps regulation risk, perhaps pressure from all over the place, and perhaps this one, you have to use more realistic borrowing cost to implement this kind of things. Because of all of these reasons, exploiting CIP violations for dollar and Mexican peso would be really difficult, right? That is the answer for these questions.